Jay Scott is a real estate investor who has generated over millions of dollars by flipping an average of 30 houses per year. But when flipping started to take a toll on him, he decided to shift to investing in large multifamily. And wow, did he make the right decision? Because what he made flipping 30 houses, he made the same with one multifamily deal. But what did he do to grow so fast? And how can single-family investors make the same transition? I wanted to know, so I called him and asked how. And by the end of this video, you'll learn how to exponentially grow your real estate portfolio. Jay, you've been flipping single-family homes for many years. What was the reason for you to transition to multifamily?
There are actually a number of reasons that I decided to transition. The most basic one was simply that I was really burned out from single family investing. We were flipping a lot of houses per year, 20 or 30 houses per year. It takes a toll. It's hard to scale a flipping business. You're basically focused on doing everything yourself, from finding the deals to renovations, to raising capital, to disposition. And it just got really cumbersome and tiresome, and I was burned out. So that was the reason that I decided to leave single family. Once I left single family, there were a couple different options. I could either stay in real estate, or I could move into other opportunities. The reason I decided to move over to multifamily was twofold, really. Number one, I really wanted to stay in real estate. So I was looking for that asset class that made sense. And this was back in 2018. Around 2018, I suspected we were heading probably into a recession. And I asked myself, if we're heading into a recession, what is the asset class I'd most like to be in to weather that economic downturn the best? And for a lot of reasons, multifamily makes sense during a recessionary period. Multifamily has historically been a very, very consistent asset class when it comes to risk-adjusted returns, and has tended to perform well both in up markets and down markets. So I really liked multifamily from that standpoint. The reason I focused on syndication was because after flipping houses for 10 years, we had a whole bunch of cash on hand that we were looking to deploy. And I don't necessarily trust other people with my money. I probably should, given that I'm a syndicator, but I always like the idea of being able to control my own destiny. I chose syndication so that I could do deals where I could deploy my own capital alongside investors.
How is house flipping similar to multifamily syndications, and what are their differences?
So most of the high-level skills are business related. So basically how to run a team and how to manage a real estate business. From a day-to-day standpoint, things are actually very different. Again, when you're flipping houses, typically you have either a small team or you're doing a lot of stuff yourself. You're responsible for finding your own deals. You're responsible for raising money, for dealing with contractors and renovating properties, for doing the marketing and sale on the back end. You might have a team around you, but because it tends to be smaller projects, you're going to be involved in every aspect of the deal. With multifamily, the big difference is that it's very much a team sport. And it's one of the reasons I love multifamily. I can take the skills that I have and I can focus on the areas that I really like focusing on, that I'm really good at. And then I can bring in other people to round out my team to focus on those areas that I don't necessarily feel that I'm good at or I don't enjoy doing.
Jay, you did very well when you were flipping single family houses. And now you're doing fairly well in multifamily as well. So let me ask a question everyone wants to know. Which asset type makes the most money?
At the end of the day, both are very transactional strategies. The goal of both flipping and syndication is to buy a property, add value in terms of either physical renovations or maybe management improvements on the multifamily side, and then resell it hopefully for a large profit. So they're both very similar strategies. In terms of what makes the most money, single family is a little bit more difficult to scale. You can make a lot of money in single family if you can get the scale. If you can do 10 or 20 or 30 deals per year, you can make a good bit of money in single family. But scaling in single family can be very difficult, again, because you're making fewer dollars per deal. You have to do more deals, which means you have to find more deals, which means you have to have more relationships with real estate agents and brokers. You have to be better at negotiating because you have to negotiate more deals. You're probably going to be raising money more one-off as opposed to raising into a fund or a syndication. So you're going to have to find more investors, and you're going to have to manage those investors individually. And so single family can be very lucrative, but along with the money comes a lot of moving parts and a lot of redundancy and really being able to manage a lot of different processes. On the other hand, multifamily, you can do 1 or 2 deals per year and make as much, if not more, than you can flipping houses. Obviously, each deal is going to be more complicated. Each deal is going to require more money. Each deal is going to require more time and effort. At the end of the day, they're both pretty similar in the amount of time you spend. It's just how you spend your time. So from my perspective, you can make just as much money flipping or multifamily, but in my experience, it's going to be much more of a headache trying to do it as a house flipper than it would be to do it as a multifamily investor. As a multifamily investor, again, you get to focus on those areas that you're really good at and you enjoy doing, and you can bring in a team around you. So from a purely lucrative standpoint, I think they're equally lucrative, but I think multifamily wins when it comes to the amount of stress and the amount of hats, the number of hats you need to wear in order to be successful.
So, one of the most underrated benefits to investing in real estate is the tax savings. Can you quickly go over the tax benefits you get in both asset types?
Yeah, absolutely. A lot of people don't recognize the value of the tax savings you get from certain types of real estate investing. And in the single family world, you don't get much in terms of tax benefits, especially if you're flipping houses. But in the syndication world, there are some tremendous tax benefits. And just to give some idea of the numbers we're talking about, on a typical, let's say $20 million multifamily property that we purchase, I might find that in year one, I have tax benefits that allow me to save or write off about $1 million of income. So if I've made $1 million in that year, and let's say my tax bracket is the 30% tax bracket, which is being very conservative, it's probably closer to 40%, but let's say I'm in the 30% tax bracket, that $1 million write-off in year one is going to save me 30% of that $1 million or $300,000. Now, I am going to owe those taxes when I sell the property down the road, but I'm deferring the owing of those taxes. So in year one, I'm saving $300,000 that I don't have to pay this year. I get to pay that in year 2 or 3 or 5 when I sell the property. So what am I going to do with that $300,000 that I save in year one? I'm going to invest it. And so let's say I invest that $300,000 and I make a 10% return. I've now made $30,000. Second year, I do the same thing. Third year, I do the same thing. Let's say we sell that property in year 5. In year 5, I now have to pay back all those taxes that I previously didn't pay, but I've made $30,000 per year in the money that I was able to defer taxes. And so in 5 years, $30,000, I just made an extra $150,000 on that deal by being able to defer taxes for 5 years. If I do 2 deals a year, that might be $300,000 a year. If I do 4 deals a year, that might be $600,000 a year. Basically, I can make almost as much money in deferring taxes and investing the savings as I can from doing the deal itself.
It's no surprise anymore that a market correction is coming. It's not the first and it won't be the last. What do you say to investors who are hesitant to do their first deal or who are currently in a deal?
So here's the nice thing about anytime you do buy and hold real estate like multifamily. This doesn't work in the flip model. The problem with the flip model is if you buy a house today and the market drops tomorrow, you've lost money and you don't have the capital to hold that asset long term. You're probably paying your lender, you're probably paying property taxes, you're paying insurance, you're paying all these other costs. And so if the market's dropped, you can't resell that asset in the next 3, 6, 9 months, you're going to lose money. But in the multifamily space, remember, you have a cash producing asset. You have a cash flowing asset. So if I buy a property today for 20 million and tomorrow the market corrects and crashes, and now that asset's worth 15 million, that's not a good position to be in, obviously, but that asset's going to continue to cash flow. It's going to be able to make enough money that it's going to pay its property taxes, it's going to pay its mortgage, it's going to pay for insurance, it's going to pay for property management, all these things it needs to pay for. And we have the ability to then hold that asset for as long as we need, as long as it's paying for itself. We can hold that asset until the market improves. And so if you look back through the history of this country, there's been no 10-year period in the history of this country where real estate values haven't gone up. So even if you have the worst timing in the world, you buy a property today, the market crashes tomorrow, historically speaking, we can expect that over the next 10 years, the market's not only going to catch back up and return to where it was, but it's going to go even higher and asset values are going to be even higher than they were. And so the important thing in multifamily, it isn't so much the timing, it's to ensure that no matter what bad thing happens, you can survive long enough for values to eventually go back up. And so we've bought properties over the last couple of years where the intent was to hold it for 2 years or 3 years. And now the market's not cooperating. The market's starting to soften. Values have dropped a little bit. We can't sell those assets for the value that we were hoping to be able to sell them for today. today. But because they cash flow, because they pay for themselves month after month, because we're in no hurry to sell them because they're producing income for us, we can wait another year or 2 years or even 5 or 7 years for the market to improve again, for those assets to be worth more than when we bought them, and then we can sell them down the road and make money. And so what I tell people that are thinking about investing today, as long as that asset is not going to get lost to the bank, to a natural disaster, to some other situation, as long as you can hold on to that asset comfortably for the next 5 or 10 years, you will eventually make money. And that's why I like multifamily, because it tends to be the lowest risk or risk adjusted returns of any asset class that I found in real estate.
If J. Scott is starting all over again today, what would be your strategy as a new general partner to be successful?
So I often think of the multifamily deal structure as everybody plays one of 3 roles. You're either finding, funding, or running. So you're either finding deals, you're finding the money or funding the deal, or you're running the deal. And if I were to start over today, I would get really, really good at one of those 3 things. I would get really good at finding deals, I would get really good at raising money, or I get really good at asset management, running the deals. And then I would find other people, whether it's 1 or 2 other people, to come in and partner with me on those other parts of the process. But get good at one thing, bring in partners who are amazing at the other things, and go in as a team. And that's what I would do if I were starting over today.
Jay's absolutely right on those skills, because regardless if you're just starting out or you're a seasoned investor, those 3 skills will still be present. As your organization grows, you will have to delegate those skills to your team members. But like anything that is worthwhile, it is going to be a challenge. And you need to have a realistic expectation when you go down this path. And that is why I think you should watch this video next year, where I reveal the untold truths of investing as a general partner.